Recent months have witnessed intense market volatility and global uncertainty. Government shutdowns, geopolitical tensions, and a $37 trillion financial reset have created conditions for sudden market shifts. Stock markets recently experienced the worst single-day point drop since April, accompanied by the largest one-day cryptocurrency liquidation in history. These events were heavily influenced by global trade tensions, particularly involving China, highlighting the interconnectedness of modern economies. Even as headlines suggest stability, underlying pressures remain. Stock valuations have reached historic highs, and investors must be aware of potential impacts on various sectors. Understanding market dynamics, including trade imbalances and government policies, is critical to anticipate possible risks and opportunities in the coming months. Trade imbalances, especially with China, have played a key role in recent market disruptions. The United States imports significantly more than it exports, creating structural economic risks. Past tariff implementations and retaliations have led to market fluctuations, highlighting the fragility of global supply chains and the sensitivity of markets to policy changes. Recent announcements regarding export controls on rare earth minerals have further added to market uncertainty. China controls a significant share of these materials, which are essential for both civilian and military applications. These measures are part of broader geopolitical strategies, influencing global supply chains and impacting various industries worldwide. Markets responded swiftly to these developments. Stock indices experienced sharp declines, while cryptocurrency markets saw unprecedented liquidations, primarily driven by leveraged positions. Leverage allows investors to control larger amounts than their initial investment, magnifying gains and losses. As a result, sudden market movements triggered mass liquidations, accelerating the declines across multiple sectors. Despite the severity of these events, market fundamentals remain strong in the medium to long term. Historical trends indicate that even during severe market corrections, recovery is possible, often accompanied by substantial opportunities for informed investors. Recognizing the difference between temporary volatility and long-term trends is crucial for effective investment strategies. Investors are advised to maintain a disciplined approach. Diversification, conservative investment choices, and a focus on long-term returns can mitigate risk. Market history shows that overconfidence, excessive speculation, and attempts to time short-term fluctuations often lead to suboptimal outcomes. Financial planning and good habits, such as consistent saving and prudent investment, are particularly valuable during periods of market turbulence. Even modest, well-considered actions can compound significantly over time, creating resilience against unexpected downturns and allowing investors to capitalize on recovery phases. Past market corrections provide instructive examples. Over the past century, the S&P 500 has experienced frequent declines, with numerous significant corrections exceeding 10%. Missing just a few of the strongest recovery days can dramatically reduce long-term returns, emphasizing the importance of remaining invested and patient during volatile periods. Current market observations suggest that while short-term fluctuations are substantial, they represent only a fraction of historical corrections. Investors should be prepared for continued volatility, but also recognize that markets often recover faster than anticipated, particularly when underlying economic conditions remain sound. Cryptocurrency markets, due to high leverage and speculative trading, are particularly sensitive to rapid price movements. The recent record liquidations illustrate the risks inherent in these markets, highlighting the need for careful risk management, especially for highly leveraged positions. Opportunities arise from volatility. Informed investors who understand market mechanics can take advantage of temporary dislocations to acquire assets at favorable valuations. Maintaining liquidity, disciplined strategies, and clear investment objectives can turn periods of uncertainty into potential growth. Long-term investment principles remain essential. Broad index funds, diversified portfolios, and consistent contributions are historically proven strategies for wealth accumulation. While market timing and speculation may seem appealing, research consistently shows that simplicity and patience outperform complex short-term strategies. Financial discipline and cautious optimism help mitigate the psychological impact of market turbulence. Preparing for potential downturns, setting realistic expectations, and focusing on controllable factors such as savings and spending habits enable investors to navigate uncertainty with confidence. Historical data underscores the importance of perseverance. Many of the strongest market gains occur shortly after significant declines, reinforcing the value of staying invested through both bear and bull phases. This principle applies across decades from 1920 to the present, highlighting the cyclical nature of markets and the long-term benefits of disciplined investing. Investors should also recognize that average returns are often misleading. Annual market returns vary widely, and a small number of exceptional days can contribute disproportionately to overall gains. Maintaining a long-term perspective perspective, and avoiding reactionary decisions is key to achieving favorable outcomes. In conclusion, current market volatility reflects a combination of geopolitical tensions, trade imbalances, and leveraged positions in financial markets. While short-term movements can be dramatic, adherence to sound investment principles, diversification, and long-term planning provide a framework for navigating uncertainty effectively. Patience, discipline, and understanding of historical market behavior are essential tools for investors seeking to achieve sustainable growth while managing risk.